There's been a lot of hype about the upcoming tariff regime, and I think the hype's probably a good word for it, because I don't think the effect is going to be as great as the hype would suggest. I think it's not good, but it's not great. I mean, you've seen by the impact on the share prices that it hasn't been too, the market's not too fearful of it. I think in the whole scheme of things, there won't be retaliation at this point, because like China's not a big exporter of steel. The NAFTA partners, Mexico and Canada, will be negatively affected, and like if NAFTA unravels, that is the big threat. But there's a long way to go before that happens. I think it's just another factor that's going to increase rates, which we've been talking about quite consistently. We had a good chat with Tony Dragicevic of Caprol Aluminium, the extrusion producer, and I think that he was relatively sanguine about the effect of tariffs, in that like it's going to really affect its smelter production of aluminium per se, not so much extrusion products. So there could be a dampening effect on the aluminium price, which is actually positive for Caprol. Caprol's share price hasn't moved that much. It's a deep value situation. So I think it goes to show that some significant headwinds have already affected Caprol, and it's producing free cash flow, and we don't see that changing. It's probably more than anything else, power prices are the key to that stock. I think the first big takeout is that stock picking is the key to making money. I mean, we've had obviously a lot of results and a lot of different effects on those results, and it's not the case anymore that a rising tide lifts all boats. It's that people are looking for value, and you're going to get value when you're paying, when stocks are cheaper. So we've seen that when stocks are expensive, they're more liable to get hit really hard. And I guess some of the stocks, like the one I mentioned before, Caprol, that rose 20%, Gal Pacific was positively received. So some of these really cheap stocks are starting to find their feet. The second takeout is what I mentioned before, which is that I guess we're seeing some unraveling of business models that I guess the market has been skeptical of, but they've been producing kind of strong cash flow, strong profit growth until now. So we're seeing that if you're just going for growth's sake, and there's nothing else underpinning that, then you're very vulnerable. We've seen that with Big Un quite spectacularly, Get Swift. We've seen that with the franchise models, Domino's. We've seen that with RFG. So we're seeing that when these sort of companies are going for profit growth just for the sake of profit growth, but they're not getting that that cash flow value, they're not getting the cash through the door, and they're using accounting tricks and they're using all sorts of tricks, the market is going to punish them, and punish them hard. Well, the market is expensive and overall, and I think that's what I've been alluding to. But I guess the key insurance for investors is buying cheap. If you're buying a company on a PE of 10 with a dividend yield of 5%, and there is a market fall of consequence, then you're going to be a lot better protected than if you're buying a stock that's on a PE of 25. I mean, it stands to reason. So I think that is our philosophy, which is buy cheap and be patient, and that is the key philosophy that we bring to the table when we're I guess advocating people buy stocks. When you're speculating on a stock, you're putting money into a stock which you can afford to lose, because there is almost a binary outcome where you can make a lot of money but you can lose a lot of money. And we make that judgment that we think the rewards outweigh the risks. And we do have a broad subscriber base, so we are catering for people with differing risk appetites. But we would say that we're in our own portfolios, we would prefer to have a speculation element in the portfolio as to be at the most 15%. Investing is a company that's either producing dividends or you can see will be producing dividends in the future, because dividends are in many ways the difference between speculation and investing. These are companies with solid business models producing solid cash returns that's not going to change anytime soon. So we're comfortable with holding this stock in our portfolio for some 3 years, depending upon the valuation. So I guess we come back to the mantra that I outlined before of buy cheap and be patient. That's very much at the center of our investing philosophy. Well, we've had some big issues with lots of stocks, and the good thing is we've got lots more to come, because we do cover a lot of stocks and the tail end of reporting season is upon us. So we've got lots of analysis coming up. We've also got our dividend portfolio coming up, which we've had tremendous success with a number of dividend portfolios, achieving way above market returns at 25% a year. And we've got sector analyses on lithium and gold.